Hey, Brian, thanks for taking out the time today to chat with us. I really appreciate it. I know you were on the podcast before, so some guests know you, but before we really dive into it, can you give us a 30,000 foot view of you?
Yeah, thanks for having me back, Peter. It's been a while, and I'm surprised anybody ever bring me back. But 30,000 foot level is I've been investing in real estate for 32 years, over 4,000 multifamily units, over 700 single family homes, buy, fix, and flip, and also rentals. I've been around a while and mostly doing commercial, multifamily, and single family residential real estate.
Nice. Yeah. I mean, last time we talked, we really got into the nitty gritty of syndication, but you're, I would say, one of the godfathers of a lot of the stuff because you started it, flipping and stuff like that, and then you really dove headfirst into getting to the nuts and bolts of syndication. So when we covered that, it was through and through pretty detailed, and I know that like the back of your hand, but kind of wanted to get as you're back on the show, kind of got like, what are you looking at right now for the market? And then, what have you been doing the past 6 months for the market change?
Well, the last 6 months, I've really been doing nothing.
Okay.
Before that, we spent about the last year and a half before the last 6 months selling. And I sold about 75% of my portfolio in 2021 and the early part of 2022, which I think is the peak of the market. And I only kept just a very few, very select Class A assets, great properties in great markets, and then pretty much put the brakes on everything else. We stopped looking at anything to acquire. I saw this coming, at least to an extent, that a change in the market coming. And the best thing to do when you see a train coming is step out of the way. So we sold a lot, and then we sit and we wait, and that's what we're doing right now. Somebody asked me earlier, are you looking for deals? And I'm like, I'm looking at deals, but I'm not looking for deals. So,
Yeah.
we've just been underwriting to stay in touch with the market and observing and basically watching the game from the grandstands.
Nice. And you've done that before when you were doing flipping, it sounded like, and you built that rental portfolio up. So this is a second, quote unquote wave or second, situation where you were able to take some chips off the table and get prepared for the next chapter. So so let's talk about your investors when you have those investors and you're like, okay, hey, we're going to put pencils down and we're not going to, etch any numbers out, or at least, I'll keep fine tuning my skills, but at the same time, we're not going to be penciling them out to actually make an investment. How does that conversation go?
Well, most of the time when we tell people that, we're on pause. So we had a multifamily fund, $100 million multifamily fund. We launched about a year and a half ago. We acquired some really great assets just before the end of 2021. And then we still had some dry powder left in the fund that we hadn't called for that capital yet. And so we've told all of our investors, we're not calling for that capital, and we're releasing them from their commitment to contribute it unless they voluntarily would like to do so. If we were to find an acquisition at some point down the line and wanted to call for capital in that fund for that future acquisition, that may be a while. So then we've told a lot of new investors that we're pencils down and we're not, that we've closed the existing fund and we haven't opened a new fund. And the answer from most people has been, yeah, that's why I'm calling you. Is well, the reason we want to invest with you is because you're not buying right now, and that's what we want to hear. We want to know that you guys are being conservative and have the market in mind when making decisions. And so the response has been extraordinarily positive, and it's been really good.
Nice. That's good. And with your experience of, a couple market downturns, especially the one back in 2008, you had that, at least peripheral vision of potentially what could happen. Some people get caught up in, continually buying and buying and buying, and puts them into a hard spot, especially with investors. So, with those conversations of people that you had or investors, what have you seen, after you have those conversations? It just builds more rapport, I would assume, with those people, and also word of mouth, right?
Yeah, I would agree. I mean, at the end of the day, investors want to earn a return, but in as much as they want to earn a return, they also want safety. They don't want to lose their principal. And I've always said, our number one job is to not lose people's money. Our number two job is to follow rule number one. And then our number three job is to produce a return, really, because you can't produce a return if you don't survive through, the tumultuous times and that sort of stuff. So people have been very positive, and that's I think people are craving somebody that's conservative and is really looking after their interests first, and not just trying to feed the beast by earning fees to keep their lights on. We're fortunate that we don't have to buy anything, and we can survive for years and years without buying a single thing and be just fine. And I think that's a really good position to be in times like this. It's that's going to be what helps us survive through the turmoil and get through to the other side.
Has there always been a rule of thumb for you, or, in an early investor age of investing in real estate, like, hey, we'll keep, 10%, 20%, as a buffer if the market does change? And what have you done for, retained earnings or emergency fund, however you want to, put it?
Yeah, we always like to have some free cash on hand, and we don't have a set percentage, anything like that. But we look at each asset when we acquire it, and we try to make a determination of how much we should keep aside in reserves, and we'll keep that aside. And generally, the riskiest point in time for any of these business plans is the early period. If you buy something and 8 years later there's some kind of a dislocation in the market, those are usually easily survivable because you've got a low basis, you've probably raised rents a lot since you bought it. Survivability is really high. But if you buy something and then 2 months later all hell breaks loose, you could be in a world of hurt.
Yeah.
And but fortunately, the way that we've always done our deals is when we're raising money for an acquisition, we also raise up front the money for all the renovations. And that amounts to a pretty thick stack of cash. So the benefit is that if something really bad were to happen, we got two things. One is we've got all the money we need to see the renovation program all the way through, including cash reserves. And the other is if something really, really bad happens and, doing renovations and stuff isn't going to make any difference, we can pause renovations and we can use that cash as an emergency fund. And, there's times when you need to pivot your business plan and say, hey, we're not going to do all these unit renovations. We're going to keep this cash sitting here. Let some of the dust settle, and then we can resume renovations, or maybe by then you burn through some of that cash. It's all kind of plays well into survivability mechanism. Fortunately for us, we haven't really seen any reduction in income. In fact, we're beating our income targets on the properties in our portfolio. So, this hasn't been a factor, but it's still nice to know that, there's a lot of money sitting there if we absolutely got stuck.
Yeah. Yeah. That's nice to make sure that you have that cushion, especially for your investors and stuff like that. I mean, I know that's, something that's probably right there at the at the very front of your agreement. Hey, we do all this, and this is X, Y, and Z of what our, market, what our plan is. For going forward, since, you have a good amount of experience with, changes in the market and everything like that. I know you don't have a crystal ball, but what's kind of your game plan for 2023 and looking to the future?
Well, it's kind of more of the same. It's going to be watch and wait. I'm in an indefinite watch and wait mode. I don't know how long that's going to last. We could find ourselves in January or February and seeing that there's been enough change in seller expectations and maybe a little bit more definition to a few of the variables that are really hard to pin down right now. But I don't think that's going to happen. I think the year's going to start off with more uncertainty, maybe a few more unexpected twists and turns. And we're going to be watching all those things from the sidelines until we can better define, the risk profile. I mean, part of our job as professional real estate investors is to try to understand where rent growth is headed, where interest rates are headed, where cap rates are headed, where rents are headed. And right now it's just, even the best of us, it's a bit of a guess. And while it's always a guess, right now it's a wild ass guess because strange things are happening out there that don't make a ton of sense. Yeah. And when you're in that kind of a climate, you got to let some of that play out first.
Yeah, no, for sure. You hit something, or at least struck a nerve with me. The variables that you're looking at, or at least watching, what are those variables? I mean, if there's, 3 to 5 or, whatever they may be, what are you looking at?
Yeah. So whenever you're looking at an income real estate investment, you're trying to model to a return, right? You're trying to say, okay, if we buy this property for X amount of dollars, we're going to achieve X amount of internal rate of return and X amount of cash on cash return on the investment that we put in. And in order to do that modeling, you have to input a lot of things: income, expenses. Income means rents. Income is all of the different expense categories. You have to input all that stuff to get your net income. But in addition to that, you also got to model out the future. And that means where are rents going to be next year and the year after and the year after that. You also have to model in the costs of your debt. So that means interest. And then you have to be able to model in your sales price. Now, modeling rents, figuring out the rent input isn't that difficult. We can look at rent comps. We can look at what the property is currently achieving, in place new leases, all that stuff to get rents. We can kind of figure out where expenses are. We can make some relatively accurate assumptions on expense growth. But the ones that are really elusive, there's 3 of them. The first one is rent growth. If you look in the history books, you'll see double-digit rent growth in a lot of markets over the last 1 to 2 years. We've seen rent growth forecasts for next year in the double digits as recently as 3 months ago, even though that's drastically changing now. We've seen just massive runaway rent growth in a lot of markets. Well, we can't assume that that's going to continue to happen. So that variable is a bit of a question mark. The other variable is borrowing costs. It's really difficult right now to know where borrowing costs are headed. Where are interest rates going? It's, some argue, well, they're about to come back down. Some are saying it's going to go up more. It's going to be high for a long time. This is going to be quick and it's going to go back down next year. You hear all kinds of things. Nobody knows. Mm-hmm. And what the Fed's doing, it makes 0 sense. And when things don't make any sense, it's hard to predict what's going to happen. So I can't make a call on interest rates. So if I can't accurately guess it, it makes it difficult to model. And then the third one is exit cap rates. And we have to figure out what this property is going to sell for 3, 5, 7, and 10 years down the road. And the way that we make those guesses is by calculating future income, which is already a little bit hard to define if we can't figure out what rent growth is going to be. And we divide that income by a cap rate. And without knowing where cap rates are headed, it's difficult to know what that cap rate is going to be. And if we don't know what the cap rate is going to be, then we can't calculate a resale price for our exit. So without those 3 variables, or at least being able to reasonably estimate those 3 variables, the market's just in my view, in a state of chaos, and it's not calculable right now. So we're out.
Yeah, no, I mean, they're all valid points. The one I would ask more in depth, because, borrowing costs are obviously being affected by everybody right now. Even if you're buying a single family or a condo, it's gone up, by 3.5%, 4%, if you're looking at interest rates. So, and then, exit cap rate, or, ARV, same thing as if you're looking at, flipping a property. The one that I do have questions about is the rent growth. So, with rent growth, granted, it's going to be stifled if there's a lot of layoffs. And that's what we've seen in a lot of big tech companies across, the plane between, Facebook and, you name it, to, just Open Door, and, Redfin, a couple other ones. So that being said, when you're looking at rent growth as a whole, are there some key indicators when you're coming out of a downturn or, a flux that you say, okay, well, now it's back to not what it was, but where it's starting to trend up?
I follow really closely Axiometrics rent growth forecast data. And it's, even though I follow it closely, I can't place any bets on it. So when I would look at that data 3 months ago, there you have 151 major markets that I look at in this study. And 50 of those 151 major markets 3 months ago had double-digit rent growth forecast for 2023. I didn't believe it. I thought, this doesn't make any sense. In the very early stage of this little wave that we're in right now, I would say let's call that period Q1 or Q2 of 2021. That's kind of when rent growth really started noticeably accelerating. And there was a really good reason for it. And that was that wage growth was expanding, and it was expanding particularly at the lowest wage tier. $10 an hour employees were all of a sudden finding $15 an hour minimum wage laws going into effect. Well, the difference between $10 and $15 is 50%. Mm-hmm. And then, your $20 an hour people are getting 27, and your $15 an hour people are getting 21. And, across the board, wages are going up, but it's concentrated on that lower wage tier. On a percentage basis, the increase was concentrated in the lower wage tier. And that's who? That's all your renters, right? So all of a sudden, in a very short period of time, the population dominated by renters was experiencing extraordinarily large wage growth by percentage. And that means that if you're a landlord and you have a 3-to-1 income to rent qualification ratio, and you have $1,000 a month apartment and your tenant makes $3,000 a month, they qualify. Well, now if that tenant gets a 50% raise and is making $4,500 a month, well, now they qualify for a lot more than $1,000. Now they're qualifying, I think it's $1,500. So mm-hmm. that's a 50% increase in rent that instantly that they can afford without even changing their 3-to-1 guideline. Mm-hmm. So rents were going up like crazy. Well, now you get into, Q3, Q4 of 2021, and then even the early period of 2022, you've got massive inflation across the board. So at first, the landlords were the only ones that were in their pocket, right? They're getting all of that extra income was going to rent. Yep. By way of rent growth. Well, now all of a sudden, gas is expensive, utilities are expensive, food is expensive, clothes are expensive, airline tickets are expensive. The prices across the board are going up, and that means all those other stakeholders are digging into the tenant's pocket, and they have less disposable income now to tolerate this runaway rent growth. So when I'm looking at that data and seeing 50 markets with double-digit rent growth, I just couldn't believe it. It's like, this is just not going to happen. There's way too many people digging into these pockets. It's just not going to happen. So I didn't believe it. Well, now I look at new forecasted rent growth data by the same people for the same time period of 2023, and there are exactly 0 markets forecast for double-digit rent growth in 2023. There are, however, 3 markets that were forecast to have greater than 9% rent growth for 2023, but only 3 markets, and 0 forecasted for double-digit. And that's because it's people are starting to catch on now, and they're realizing okay, this rent growth isn't going to continue forever, and that's that's the data that we're looking at. And some of it is just a common sense interpretation of what's going on in the world. And right now, I don't see anything going on in the world that points me to, hey, rent's going to start taking off again.
Got it. Yeah. I mean, that was a detailed answer, especially, a high level answer for looking at rent growth and being able to pare it down to exactly, what at the basis it is, or water down what ultimately is affecting people to get into, a property or be able to pay for that property, at $2,000 a month or, $4,000 a month. Do you see, as we go into next year, do you see, a significant change with what the feds are doing to tamper the challenges that we see today? Inflation, all these other, expenses that people are facing.
Well, I'm no economist, but I almost feel like I could run the Fed better than what they're doing right now.
I know.
I mean, the part that doesn't really make any sense to me is like, okay, here's the scenario, right? You have the population that you're responsible for, all of them pounding their fist on the desk saying everything's too expensive. Prices are going up and we're not going to stand for this. So what do the politicians decide to do? Or Fed people, I guess maybe they're not politicians, whatever role they play. Well, their answer to this is to say, okay, so we'll help you. We'll make your mortgage payment double and we'll make you lose your job. There you go. That'll help. So that seems to be their practice right now, is to say, like, we're determined to break the economy. That's what we're going to do. We're going to raise interest rates until we break the economy. In other words, until people lose their jobs, they can't afford to buy houses, borrowing costs go through the roof and everything gets even more expensive. They think that's the solution, when really the solution is to stop spending, right?
Yeah.
So with that level of insanity out there, it makes it nearly impossible for me to predict where interest rates are going to go, because what they're doing doesn't stand a rational test.
Yeah, no, I agree. I mean, you hit the nail on the head with, how they've been treating this, and also, even blatantly saying, yeah, we're going to, put the nails to the coffin to push this into overdrive as the economy, nosedives. It's like, we're going to do whatever it takes. Doesn't matter if we crash the economy. We're going to continue to do what we're doing until we see a change. So yeah, that's just a reckless way to look at it, and
thereby injuring the very people they're supposedly saying they're helping, right?
Yes. Yeah. And the very people that they gave money to too, especially in, the nosedive economy. Granted, we didn't know exactly what was going to happen in 2020, but the same people there, those same people that, like you just said, the rent growth that's going to go up 50% are the same people that are having the biggest impact on them changing or increasing the interest rates and, driving those rates up each and every time that they meet. So, and they see it, and what would you say, especially talking about job growth, or at least rent growth, but let's switch to job growth, as the jobs report just came out, and they added 237,000 jobs to, companies nationwide. Do you see that? And does that make you more perplexed? Because, on one side, right? And this is kind of, I say this rhetorically almost, is because one side you see all these companies headlines, Open Door, Redfin, Google, all these other, companies are laying people off. But then all of a sudden you see the jobs report that comes out and says they added 237,000, which doesn't make really a ton of sense.
Yeah, it doesn't make sense to me either. And that's why I'm not an economist, I guess. But I do wonder, how is that going to keep up? Because a lot of these layoffs that are being announced, those people haven't been laid off yet, right? The company's saying, like, we're going to lay off 11,000 people. Okay, well, they're still sitting at a desk today.
Mm-hmm.
But over the next 60 days, they may be losing their jobs, right?
Yeah.
Or a lot of these job losses are job losses by attrition, where it's like, okay, we're going to, as people retire, we're not going to replace them. Or when people quit, we're not going to backfill those roles. So you have a lot of that going on, where I just don't think it's filtered its way into the numbers yet. And it probably will, is my suspicion. But I still feel like, housing overall, the fundamentals of housing are actually quite good.
Yeah.
Jobs are strong, incomes are strong, incomes have been rising. If the Fed would leave this alone and stop screwing it up, that would continue. If they could stop all the spending, then especially government spending with handing out helicopter money literally left and right, if they would knock that off, the inflation would moderate itself without the Fed getting in here and screwing everything else up. And then maybe we wouldn't see all these job losses. But fundamentally, the real estate market is quite good. It's just the problem is cost of borrowing and all of the unknown variables, like where is rent growth and cap rates, where are those headed, just make it uninvestable right now until those can be better defined. And so we're just waiting for that to happen. Prices need to come down to account for the new reality. And once they do, then again, real estate's pretty solid and it'll do fine, but prices have to come down in order to get it there.
With you coming from, a solid background in, what we saw, 12 years ago, 14 years ago to today, do you see, granted, fundamentally, like you said, they were, solid loans that were happening. It wasn't, some types of loans that people were giving just because they were saying a number that they were making. And, you can go down that rabbit hole of what we ended up experiencing then. I personally think, with the supply that we have now versus what we did then is significantly less. So I feel like that has really helped let's just talk housing market and real estate market centric right now. I feel like the supply chain has really helped in that way to still keep prices somewhat stable, not where they, drastically dropped. And granted, we're still 8-9 months from when they started increasing rates, but and it takes a while for sellers to say, you know what, never mind, this house, I should sell for $50,000 less than what I'm at now. Now I realize. I feel like then looking at a house per house, there was in Orange County and that's where I'm at, 18,000 listings in 2008 active in Orange County just alone. And right now we're at 3,862. So we're 5 times less than we were. Do you feel like that is helping the scenario for real estate specifically?
Yeah, I think it's hard to draw parallels between what's happening right now and the 2008 collapse, because in 2008, well, actually it really started in 2005.
Yeah.
The light switch flipped in August of 2005. I can almost remember the day. I can almost pinpoint it down to the hour. When the light switch flipped in 2005 and caused real estate to begin to collapse, the economic collapse of 2008, 2009 was caused by the real estate collapse that actually began in 2005. And when real estate causes the economic collapse, real estate's going to take the hardest hit. And it did. Values fell in some areas 70%. We saw some real estate fall 70% in value. And we're talking single family homes and condos. I don't see that happening this go around. Again, real estate fundamentals are still quite good. And so, and in the residential real estate space, such as single family homes and condos, most of the trades that have happened over the last 7 or 8, 10, maybe 12 years, maybe even 15 years now, have been with healthy down payments and or good loans with fixed interest rates or maybe floaters with low caps and, again, good down payments with pretty strict qualification guidelines, with a few exceptions. And that's going to shore up the real estate market in a lot of ways, because what happened in 2005 that caused the 2008 collapse was just really crappy financing. No money down, negative amortization, floating rate stuff. It was just, liar loans, ninja loans. They had all different kinds of names for them. Yeah. And that was just a disaster waiting to happen. And it created the very disaster that it deserved. And that was what it was. This go around into something entirely different. This one is being caused by actually too good of an economy, right?
Yeah.
Inflation going up and spending going up and all that. And then they come in here with these interest rates and they're trying to crash things. They're not going to be very successful at crashing the residential real estate sector in terms of single family homes and condos. We're probably going to see some reduced sales velocity.
Yeah.
Because some people are going to have to sit on the sidelines of the market for a while. But I mean, shoot, when I bought my first house in like 1990, I had an 8.5% interest rate. And I thought that was good,
Yeah.
So historically speaking, we're not that far off the mark. And I think that's going to work its way out without some serious price reductions. The majority of my business is in multifamily, large commercial multifamily apartment complexes. And in that space, that's where we're going to see, in my opinion, the most pain. And again, it's not because rents are going down or occupancies are suffering because the real estate market's fundamentally broken. It's because, financing has gotten crazy whacked out of control. Interest rates are all over the board. Rent growth is a big question mark, and nobody really knows where it's going. And that's where I think we're going to see the most compromise in value, is in that sector.
Yeah, I mean, especially with, and you've probably seen a lot of this with, deals that are going to close and they're interest only. And then all of a sudden, things change and it changes quickly. So a ton of investors will back out or, funds will back out because ultimately they're not getting that, that return that they initially promised or, said that they were going to get on that property. Right.
That's right. And, and now you've got people that are still out there buying and still promising all kinds of crazy returns. And there's just no way that they can legitimately promise those returns with all the unknowns. I mean, some groups, maybe they get lucky. I mean, the things could look, day after tomorrow, they could announce they're going to cut interest rates by 75 basis points and do that for the next 3 or 4 meetings. And the bond market follows and borrowing costs trend downward and capital gets freed up. And anybody that bought right now is going to look like a freaking genius because all their numbers are going to come in better than they expected. I highly doubt that's going to be the scenario. I think we're going to see, more increases and that they might actually be there longer than we think. And that there may be a bit more pain on that side than a lot of people realize.
Yeah, for sure. What would you say, especially some of the headlines that have come out recently, and some have been there for a while. So like Blackstone, BlackRock are buying up, D.R. Horton, blocks of single families and, renting them out. Is that something that you've ever looked at, especially for your funds? Has that something that you have even entertained? I know Chase just came out and said that they were, looking to joint venture with a company to buy $1 billion worth, stuff like that. Has that something come across your table?
Well, we were one of the first people to do that way back, I don't know, 15 years ago. We were buying homes and assembling, massive blocks of rentals. And, we were buying a one-off at the foreclosure sale.
Yeah.
And, now you've got people that are coming in and some of these groups are buying up entire subdivisions or they're purpose building subdivisions for the purposes of rental housing. And that particular strategy isn't really, I wouldn't say all that new. It's just gotten a lot more press lately. There's a subdivision not too far from where I live that is built back in the early 1990s. And the thing was purpose built as rentals, the whole subdivision. And it stayed that way until like 04 or 05. And then they saw where values went and the seller decided to sell them one off.
Yeah.
He made an absolute killing. But then, of course, those same houses went half in value down 2 years later, and all those owners lost them in foreclosure, and we bought some of them, and the road all the way back up again. And so, our whole philosophy though was we were looking for a pricing dislocation. When we bought our blocks of rentals, we were buying them in like 09, 10, and 11. And with the thesis that they were going to double in value in 5 years. Now, back then, everybody said we were crazy. It was too early. What were we thinking? We were mad. And then, 5 years later, it turned out we were wrong. They didn't double in value. In fact, they doubled and a half in value. And then we sold them all off, one at a time. And it was the greatest trade we ever made. I mean, it was a great strategy. I mean, we kind of bought at the bottom, sold at the top, and that was great. But then after we did that, all these other groups start coming in and start buying up all these buy to rent, this buy to rent strategy. It's a new strategy. It's like, new strategy. We just got out of it. What are you thinking? It's like, you're not going to get a doubling in value. So, it's these single family homes in bulk don't cash flow the way, multi-housing does. So personally, I don't really understand the strategy. I don't get it. I don't see where it's really that lucrative. But I guess if you do this on massive scale in the terms of billions of dollars, then maybe somehow it makes sense.
Yeah. I mean, I could see obviously, they have to put some money that's on their balance sheet somewhere, and that might be, the conversation at hand right now is like, okay, well, depending on where we're at, we could be in a subdivision outside of Atlanta, and we've seen a lot decreased over the last 6 months, year, just because the interest rates. Maybe we'll just buy up 100 of them, or or this builder's coming in and they don't want to, they're not meeting exactly what they're going to sell them for. So, they make a deal with, BlackRock or something like that. So,
well, just because these big boys say that the strategy is the greatest thing I've ever seen doesn't really mean they're right. I mean, didn't Zillow to this strategy and then almost took the company out, right? And so now they're not doing it anymore. So they can be wrong too. It'll be interesting to see how it plays out.
Yeah, I mean, I think there's a few companies like that. Redfin just said that they're going to stop, buying because they were doing the same exact thing, and then Open Door is built on that. That's the only thing that they do, and they're buying properties. We've gotten a few of them into contract and closed, and they bought them for $50,000 above what we ended up closing on. And even with their fees, they weren't able to match what they, ultimately said for one that they were going to be able to sell it for, because I don't believe across, and I think that unless you have true boots on the ground in those areas, just like looking at properties or looking at single families or mobile home parks, if you don't have boots on the ground there that know the ins and outs, you're going to get screwed. If you look at it literally as a 30,000 foot view and just say, okay, cherry pick ones, but you don't have that actual street knowledge of the area and the comps and stuff like that, you're going to get burned. And that's what happened.
I totally agree. I mean, I was buying houses at the foreclosure auction, when foreclosures were everywhere. And then all of a sudden Blackstone decided to roll into town and do the same thing. And they were literally buying hundreds of houses a day. And I remember specifically this one, all the time we would see them like way overpay. Like our max bid is 250,000 and they buy it for 300. And it's like, what are you thinking? Yeah. But I remember one day in particular, we were at the auction bidding on this house and we reached our max bid. And then after we dropped out, two other bidders went after each other for another 25 grand before they both realized they both work for Blackstone. And it's like, you guys just bid yourselves up. And it's because they get too big and they just can't keep track of all the details. There's no way that you can employ a single family strategy on massive scale with the same efficiency that a smaller operator who really knows the market and is really paying attention can do. But they don't have to. They do it at such big scale that those inefficiencies become rounding errors.
Yeah, for sure. Yeah, exactly. Like you said, I was going to say the same thing. It's nominal at that point because they're, that's not their bulk. If they were just doing that, just like these other companies, and that was solely what they were doing, yeah, they can get good at it for a while, especially in an upward trending market. But at some point it will catch them, and it caught them. And obviously that goes to show with, like we talked Zillow and stuff like that. So as we kind of, push into 2023, looking at, multifamily and the stuff you said you sold about 75% of the portfolio, with sitting on the sidelines. And I know you don't really know when you're going to jump back in. Are there, is there indicators that you say, okay, hey, yeah, I'm good. Like I'll jump back in when this happens?
No, because when that happens, something else might happen too that makes that irrelevant. So there's a lot of things we have to look for. I mean, so what I want to be able to do is I want to be able to find some reasonable future rent growth forecasts that I can pass the gut check with and say like, okay, this actually makes sense. I think that the rents probably will do what these forecasts are saying. And I rely on third-party forecasts because I don't want to just make it up. I can't tell my investors like, oh yeah, 3.8% rent growth. Where'd you come up with that? I just kind of thought maybe, that would be good. No, I want to be able to point to say, look, these are economists. They do this for a living. This is all they do. And this is what they're saying. And I believe them. Yeah. Right now I could say, but I don't believe them. And so if I don't believe them, I can't put that into our model. And then that means that, the numbers don't work. So I want to be able to see rent growth data that I can actually believe is going to happen. I want to be able to see some kind of stability in borrowing costs so that I at least can understand where borrowing costs are and maybe have some idea of when that direction might change and which direction that might be. Yeah. And then finally, I want to be able to understand what I can sell for a few years down the line. And until I can understand those three things, which are all in such massive flux right now, there's so much movement in those three variables that I can't understand it. When I can understand all three of those, then I'll probably jump back in. Now, in order to be able to understand all three of those, a lot of different things might have to happen. So I can't say, oh yeah, well, this one thing will happen and then all those factors will fall into place. Maybe, but maybe not.
Yeah, for sure. It's just like, before, and just like as we go through a market, doesn't matter if, like back at the end, I remember back at the end of 2018, they started increasing interest rates, and it kind of, made the market just a little bit for like a couple of months go, a little topsy. And then they realized what they were doing and they, pulled it off. So, and we didn't know then what was going to happen, but then they immediately said, okay, well, this is too much. We got to, take a left turn and go back the way we were. So changing gears to your book, I know you wrote a book, and The Hands-Off Investor. How was that as a whole? Did you always plan on writing a book, or is that just something after you're doing, syndications and stuff like that you're like, hey, this is something that I should put out, or I feel, very passionate to do?
Well, if my high school English teachers knew that I was a published author, they would be convinced that there was some sort of mistake. Yeah. So no, I never really planned on writing a book. For many, many years, people have said to me, hey, you should write a book. But I always dismissed it like, hey, look, I don't know enough. There's no reason I should be writing a book. I need to get more experience or whatever. And they're like, experience? You've been doing this for 20 years. You've done like 500 properties. What are you talking about? It's like, well, that's not enough, So I never really had the confidence to do it. And it wasn't until, I think back to a story of a friend of mine who, basically took her entire life savings, which came out of a 1031 exchange from some fourplexes that she had. That was her entire life savings. And she invested it into a passive real estate offering that was structured as a tenants in common type of arrangement, where it meant that she could actually do a 1031 exchange, take the funds from her fourplex, invested in this deal that was buying senior assisted living facilities. And about a year later, it was discovered that the sponsor in charge of this investment was a prior felon that had mail fraud and wire fraud convictions. It wasn't disclosed in the documents. Anyway, long story short, he ends up basically fleeing with all the cash. The investors get left with nothing. The property goes into foreclosure. My friend loses her entire life savings. And then coupled with that, I get questions from accredited investors who, these are the people who are so-called allowed to invest in private offerings, right? As accredited investors, meaning that means that they're smarter than everybody else. Yeah. And they're calling us and asking really dumb questions. It's like, you're not asking the hard questions that really matter. Yeah. So I got to thinking like, okay, even the people who really should know don't know the right things to ask. And then you got people that don't know, that just make willy-nilly decisions and lose their entire life savings. If there's anything I could do to prevent that experience from happening to someone else by educating people to tell them what they really should be asking, this would all be worth it. It would be worth the effort. And that's really kind of the seed that planted the idea for this book, is if I could teach passive investors what to look for, what to ask, and the right way to do it, I could save somebody from that horrible experience.
Yeah, no, I mean, that's a That's a brilliant way to, go about a book. Some people do it just because they want to make money. I mean, obviously I know that you got a day job, so it's not like you need the money to go out and, write multiple books. So you do it as a passion project because, some other situations and experiences that you had friends go through felt like you were, it was almost a must, and you had to get that book out there to be able to educate people. So
yeah, the book royalties are a rounding error. Believe me, I don't make my
yeah.
money by writing books. I mean, I make my money in the real estate market. But I will say that having written this book has been very beneficial to our business in a number of ways. I mean, obviously, we get some recognition by people who say like, hey, we want to invest with you because you obviously know what you're talking about. You wrote the book on how to do it.
Yeah.
But we also get the benefit of having better educated clientele. And when people are investing in our projects and they really understand what they're investing in, it's better for everyone, because it's not a good situation when you're responsible for people's money and they have no idea what they're investing in, because ultimately it leads to some kind of collision down the line where they're like, oh, hey, yeah, I need my money back because my cousin got sick, or I need to bail him out of jail. Well, it's like, you would know if you knew how these work that you can't just get your money back,
Yeah.
right? So, you prevent those kinds of uncomfortable moments in the future if you have a well-educated clientele.
Yeah, no, for sure. And I think, like you said, it's multi-pronged because, you put it out there and you're able to, have reinforcement with the people that ultimately maybe were on the fence about investing with you, and now they're willing to. And then people that really never heard about you, but someone suggested the book or, referred the book to them. And then now they're, ready to go because, they didn't really know, someone out there that's doing what you're doing. So that's huge. Well, we went through the top questions that I have at the end, but since I got you back on the show, we went over kind of your, not so much predictions, but conversation about next year in your book. But is there anything that, I didn't ask you that I should have asked you on this interview?
Well, you could ask me where the next million to be made is located.
Yeah, where is that?
I don't know. I'm really not sure. We're still looking for that too. I will tell you that I have learned over the years that it's much easier to lose $1 million than it is to make $1 million. So that's why it's so important to really pay attention in this business.
Yeah, well, I mean, I think I would say overall, for sure, real estate is easy to lose that money, or just bad investments in general. So that's why, like yourself and a lot of other people that are putting, content out there that, really know it are very valuable, because ultimately the people that follow you or follow, what your trade is will actually become rich. It's going to take a while, but they'll get there.
Yeah, that's what we hope. And if my advice doesn't get somebody rich, but at least saves them from losing the wealth that they've accumulated, or at least some portion of it, then that's just as valuable as well.
100%. Yeah. That goes, is the same amount. So, well, cool, man. Well, Brian, thanks so much for your time. I know your time's valuable. So I just want to say thank you from, my audience, and I appreciate you coming back on the show.
Anytime. Thanks for having me back.
Cool, man. Thanks.
You got it.